Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is revenue recognition, a specific topic on revenue recognition called the right of return. So, we have the 5 steps to recognizing revenue: identify the contract, performance obligation, transaction price, that is our issue here, and then allocate the transaction price. And when recognize revenue when or as each performance obligation is satisfied. So what is the problem with the transaction price here? Is the right of return. So here in the US and some countries, the right of return exists when the customer can return the good if not satisfied or unable to resell it. View it as a failure to satisfy the original performance obligation. And sellers report net sales revenue in the income statement, equal to gross sales revenue less actual and estimated returns. For instance, let's go to our Excel file. And by the way, we have a video about sales return, how to journalize it, and so on. And the video is in our video description. So here, assume that Scarpin Corporation sold 10,000 products to Santee stores for $500 each. So the sales revenue would be $10,000 times, or 10,000 units times $500, $5 million. Scarpin Corporation estimates that Santee stores will return 4% of the products purchased. Some countries, like the US, work with the estimation on return. Some countries recognize it only when the return actually happens. So here, estimated returns, the 4%, 5,000, or 5 million, times 4%, $200,000. So the net sales, or the transaction price for this sale is $4.8 million. So sales return, or the right to return, is an issue of revenue recognition too. Okay, guys, that's it. Short video, we don't need that much for the right of return. So questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.